Hi everyone, I'm Lien. Welcome back to the channel. You've asked for more trading strategies, so today I'll show you how to turn the Relative Strength Index, better known as RSI, into a powerful strategy for trading Forex, gold, and indices. 343 on this chart over here. Those are the odds that I like. But before we dive in, make sure you hit that subscribe button so you don't miss any of my trading strategies, live trading sessions, and market updates every single week. RSI is actually one of the world's most popular technical indicators. Millions of traders use it every single day to measure momentum and spot when a market is overbought or oversold. At first glance, it seems almost too simple. Numbers above 70 mean overbought and a sell signal. Numbers below 30 mean oversold and a buy signal. But if you've actually tried trading RSI this way, you already know that the textbook way isn't always the best way. Why? Because Forex and gold can trend hard. When there's a strong fundamental reason for a currency like the US dollar or gold to rise, those drivers can usually persist for weeks or even months before they fade. For example, if the Federal Reserve unexpectedly signals more interest rate cuts, the selling pressure doesn't just stop because RSI hits 70. The same is true on the opposite side. If there's a crisis of confidence in the currency, the selling can extend far beyond oversold territory as investors rush for the exits. That's why RSI can stay extreme for long stretches and why so many traders get trapped fading strong moves, selling too early or buying too soon. That's why in this video, I'm going to break down what RSI really is, why the classic method fails in trending markets, and then I'll share a simple tweak that makes RSI far more reliable. Stick around to the end because I'll show you the exact step-by-step strategy, plus a quick checklist that you can use on your own charts. Let's start with understanding RSI. Now, the RSI Relative Strength Index was created by J. Wells Wilder. It's a momentum oscillator that basically moves between 0 and 100. Above 70 is traditionally considered overbought. Below 30 is traditionally considered oversold. Now, anywhere between 30 and 70 is a neutral zone where markets are consolidating or trending steadily. RSI measures the speed and magnitude of recent price changes. The best way to think of it is like a pressure gauge. High readings mean buying pressure is intense. Low readings means selling pressure dominates. RSI is popular because it's simple to use. One line, one number, easy to understand. It works in any market, Forex, stocks, commodities, crypto, and it has clear rules. Buy under 30, sell over 70, which feels like a simple traffic light system. But popularity doesn't equal profitability. And here's the trap. Most traders are taught, buy when RSI drops below 30. Sell when RSI rises above 70. Sounds great in theory, right? But here's the problem. In strongly trending markets like gold or major FX pairs, RSI can stay above 70 or below 30 for weeks. Instead of being a reversal point, these readings are often the mark of the middle of a move, not the ends. An example is gold. It can rally on inflation fear. It hits RSI 75. If you sell there, you're basically shorting into strength and the price just keeps climbing. Or the euro plunges and the RSI drops to 25. You buy and the downtrend continues, leaving you stuck. That's a danger of using RSI mechanically. Now here's a tweak that can change everything. Instead of reacting to the first time RSI hits 30 or 70, you wait for the second time it visits those levels, the double dip. This filters out false starts and captures the real move that often follows. Let's wrap around some practical rules around this. Step 1, put the RSI on your daily chart, gold, Forex, whatever you want. Step number 2, for buys, wait for RSI to dip below 30. Close above it, which is the first oversold signal. Don't take that trade. It just puts the setup on your radar. Then wait for RSI to drop back below 30 a second time at closing basis and then rise back above 30. That's your setup. Enter long after the second dip. Step number 3, place your stop loss just beyond the most recent swing low and risk no more than 1 to 2% per trade. Step number 4, aim for the 21 EMA. We'll look at examples in just a second. Before the short trades, the rules basically the reverse. For sells, wait for RSI to climb above 70. Ignore the first touch. If RSI falls and rises above 70, that's your setup. Enter short on the second dip below 70. Place your stop just beyond this recent swing high, aiming for the 21 EMA. Now let's see how this looks on the charts. Okay, so let's go ahead and add RSI to our charts. We're looking at my daily Eurodollar chart. I'm going to type in RSI, which is the Relative Strength Index. Now, this is the RSI on the bottom. As you can see, RSI has a zone that's shaded. 70 and 30 are the top and bottom of the zone. So when RSI goes above 70, that is considered overbought. When it goes below 30, it is considered oversold. Anything between 30 and 70 is the neutral zone. We've talked about this already. Now, if you used RSI in the classic way, you would have sold as soon as it went above 70, which would have been here. So you started selling at 116.95 and actually went pretty much 140 pips against you, which is a big move. Many of you may not be able to tolerate this before it finally moved lower. And if you tried to set your stop with the prior high, you definitely would have been stopped out multiple times on the top. So what can you do instead? You can add the RSI and look for the RSI double dip, where you basically look for RSI to rise above 70, and you wait for it to close back below it and dip back below it. So before we get to that, I'm going to add in the 21 EMA, which is what we use as our target, the exponential moving average. I typed in EMA, click on exponential moving average. I'm going to change this to 21. So this is the 21 EMA here that we're looking at. So let's take a look for our setups. So the first setup we have is over here, where RSI does go above 70. And you can try to sell here, but you can see that it would have been a bad idea because it made a new high afterwards. So RSI goes above 70. It actually dropped here back below 70. You can see here in the reading, it's just 69.5. It drops below 70. We wait for the second dip. So the second dip in RSI, let me get my arrow, actually happens over here. And if we put our vertical line down, that second dip in RSI happens right at this candle over here. So you would have sold right at this candle here at 114.20. So 114.20 is where you had sold. And let me remove this line. So you would have sold at 114.20. Where's your stop? This is where you sold, 114.20. Your stop should be at the swing high, which is the most recent high. In that case is 115.73. So your stop is 115.73 stop. This is your entry sell. So it's a pretty hefty stop, 115.73, but it doesn't go anywhere near that. So when do you close the trade? You close the trade when it touches the 21 EMA, which in this case is 112.70. So we exit the trade at 112.70. If you want to trail your stop, you can, but that is up to you. So it's about a 1-to-1 risk reward, not great, but you really could probably narrow it to 100 pips. It never really goes back to that. But this is a very clean visual way where you see that we had an attempt to show exhaustion. It was a fake out, made a new high, dropped back below the RSI. And this is a high probability trade with very little move against you to at least the 21 EMA. Now you would have asked, Kathy, wouldn't this be a double dip right here? No, because it actually moved, very far down. We wanted to stay kind of up in this area here and actually moved below the yellow line, which is, kind of relevant as well. So, but we do have another double dip over here. So we rise above 70. This is where it goes on your radar, and it drops below 70. This is where, okay, it's time to watch for a double dip. Here, it rises back below, and then it dips again right here. We enter it right at this candle here. So we're basically selling 109.02. Stop in this case is much tighter, 109.54. So 52 pips stop. We exit over here, 107.44. That's like 200 pips. So you're risking 52 pips to make 200 pips in this trade. Now, let's see if we have some more examples. Here's another example. Here we dipped below 30. This is a long trade. Now, if you sold there, it rallied a little bit, but it made a new low. So that was not the real turn. The real turn happened to the second rebound above 30. So you would have gone long right here. That's when we go 30. Now this one, you go on long here. The stop is kind of big, I think. 104.96. Stop is at 103.30. So that's pretty big stop. Even if you used 100 pip stop, I think if we went short at 104.96, 100 pip stop is sufficient. So 104.96, targeting this close here, 105.89, almost 100 pips, very little move against you. So I think, how many were we looking at? 1, 2, 3, 3, 4, 3 on this chart. Here's another one. Here, if you sold when it went back above here, at the first rebound, that would have been a bad idea. Instead, you want to buy here, where RSI down here goes back above 30 for the second time, which basically puts us at this green candle. Not this one over here, but this green candle over here. So we go long, very logical stop. We go long at 108.28. Stop is 107.60. So basically 4, 5, 6, 70 point stop. You close it here at 108.88. So we go long at 108.28, 88. So that's like an easy 60 pip move there as well. So how many have we looked at on the daily chart? We looked at 1 here, 2, 3, 4. 4 winners here on the setup. I can show you another one here. RSI goes above 70, drops below, not the top yet. Second double dip over here, you're selling at this point here on the double dip. So that's selling at 111.61. Pretty tight stop for about 40 pips. And your target here is pretty much 110 pips is what you made. So 5 out of 5 winning trades in Eurodollar. So no more setups until we get over here. And here we have the rise above 70, drop below. Don't take it yet. Wait for the double dip, rise below 70, drop below. This is when we sell. We sell pretty much the ultimate top of this move at 109.70, stop at 110.17, so about a 50 pip stop, let's just say. And then it goes all the way down to 108.30. That's, 130 pips. So 6 out of 6 winning trades. This is another one over here, picking almost the perfect bottom over here. You don't sell here because it made a new low. You wait for the new low to happen. You wait for the RSI to rise back above, and then it hits here. So 7 out of 7 winning trades so far in this Eurodollar chart. So let's take a look at how this works on gold. Gold is definitely choppier, I'll have to admit. So with gold, let's see if we get a double dip here. Here, you try to sell here. No. Here, you try to sell here. It actually is a fake out because it continues to rally. So this is where we get the first move down. You sell here with a stop up over here, targeting the 21 EMA. That becomes a winning trade. Here, you don't sell the first dip, you sell the second dip, which is over here. So we sell this candle, thankfully sell at the close so that you sell pretty high up, 31.10, and your target is almost 100 points lower. 2 for 2 here. Here, you don't sell when it drops here, really bad move, it's a fake out. You wait for it to rally, and then you wait for it to close here. So we sell here at 32.60. Stop is pretty hefty, but it does make it to 21 EMA before you get out. So 3 for 3 on this chart over here. Those are the odds that I like. And here we have another setup. So here you don't sell this. You wait for the drop. You wait for the move back below and pretty much sell the top over here. Another beautiful move. 4 for 4. These are the odds that I like with the RSI trade. So hopefully I've shown you how to turn RSI into far more effective, high probability strategy. The reason why this setup works is because strong trends can easily carry RSI through one overbought, oversold phase. But by the second time, momentum is usually overstretched and reaching exhaustion. Also, skipping the first touch avoids premature entries and catching a falling knife, for example. Finally, you're only trading when the market confirms that extreme condition is more than a one-off spike. Like any method, practice on a demo before risking real capital. If you want more strategies like this, type more strategies in the comments below. And don't forget to subscribe and join our free trading community. The links are in the description. Thanks for watching. I'll see you in the next video.